We're joined for more by Stephen Nash from FIIG Securities at the camera there in Sydney. Stephen, good to see you. Thank you so much for joining Carson and I.
Thanks.
In terms of that rate cut this morning, there are a lot of people expecting a cut. Were you at all surprised at the size of it, though, and the statement which seemed to suggest that the RBNZ is maybe a little worried about how severe the impact might be?
Yeah, I think that this is on the extreme side of the range. I think people are expecting 25, 50 is probably a little bit higher than people are expecting. The statement indicated that the RBNZ was concerned that GDP was a little bit softer in the second half last year anyway, and this is more in the style of an insurance move with a view to making sure that the earthquake doesn't damage the economy. But yeah, it was a little bit on the higher side in terms of the cut.
Would you say it's the one cut only for now? Even if conditions deteriorate more than what the RBNZ suggests at this point, could it cut again?
I suppose monetary policy is always open in that sense, and that it really will depend on how the economy evolves over time. I mean, if they get a strong, a lot of demand and the economy starts moving up again, then I imagine that things will change. But at this stage, as they have said, the economy was looking weak before the earthquake, and so that is the trend that they're responding to. Yeah.
Can we just look ahead as well, what this decision might mean in the next 12 or 18 months' time? Because a suggestion has been made by one economist already that just at that moment in time you'll have the rebuilding in Christchurch taking place, you'll have inflation from higher commodity prices, and as a result you'll have a double whammy hitting that economy. Were they too preemptive?
Look, I think it's always easy to criticise authorities. I think the Christchurch situation is a very serious one for New Zealand. I think they need to do this right now. But as you say, that there are possible arguments for a rate hike further out. But I think they have to take account of the conditions as they see them right now. And I think the situation is pretty dire over there.
I do understand that. I'm just trying to draw parallels with the rebuilding effort here, which we have said and acknowledged is going to be inflationary for our own economy, and allied to which you don't see the real flow through for another 12 or 18 months. So it's like perfect storm. You'll get all factors coming together. How do they then handle that?
Well, the RBNZ has been quite aggressive in the past with regard to rate hikes. When they need to tighten, they're quite aggressive. I imagine that they will do that if they see the need. I mean, the parallel here, I think, one could argue we've had a very severe, a lot of natural disasters here. Why doesn't the RBA ease? I suppose the answer would be that the effects are not as severe in this country.
Do you think a monetary policy stimulus like this rate cut from the RBNZ is going to be more or less effective than perhaps a stimulus package that the government could have initiated and be more targeted with?
Look, that would have been a possible action by the RBNZ, but I think the New Zealand economy has already been questioned in terms of credit rating. They've got to be very careful with that. I mean, that goes straight to the comparisons in Europe, and I think they've got to be very careful on the fiscal side right now.
How are they going to handle retirees and others in the economy where those term deposit rates are now going to be slashed, Stephen? That's going to be a real cost impost for people at a time of heightened global commodity prices being passed on to consumers.
Yeah, it will be quite tough for people on fixed incomes there, and I imagine there may be some measures that the government introduces to help ease those problems. But I think the priority right now is to get this cash rate a little bit lower to allow a little bit of breathing room and build a bit of momentum in the economy.
This decision today is opening the door, as some have said, to stagflation, that you may well get a thematic of high inflation, high unemployment, and that is a recipe for a bigger headache than today.
Yeah, well, the stagflation's been a theme in global markets for quite a while, as we've been discussing, and New Zealand won't be immune from that if that was to occur. I think the problem with commodities will probably be sorted out by this oil price. As the oil price rises, I imagine we're going to get a moderation in those commodity prices, as your previous speaker was discussing there.
Stephen, we've got another guest coming up on New Zealand rates, so I just want to ask a quick question about jobs before we leave you here in Australia.
Yeah.
We'll get the jobs numbers in about 2 hours' time. If we see an unemployment rate at 5% or even lower, is the market going to be excited by that?
Look, I think it normally would be, and it probably will to some extent, but we have had a series of quite weak readings, economic readings of late. The consumer confidence, the business survey recently, also housing finance, quite weak. So I imagine that if we get something like 4.8% unemployment, the market will put that in a broader context. You're seeing quite a few of the mainstream forecasters putting back their estimates for a rate hike from, say, May to August. I think that's a continuing theme, so the rate of unemployment now is probably less important than it has been in the last, say, month or so.
Stephen, thank you so much for joining us today. Appreciate it.
Thanks a lot.
Stephen Nash from